The Little Book That Builds Wealth, The Knockout Formula for Finding Great Investments by Pat Dorsey. In this episode, we are reviewing The Little Book That Builds Wealth. The core content of this book teaches us how to judge a company's economic moat. The concept of an economic moat should be familiar to you. It was first introduced by the legendary investor Warren Buffett. In the 1990s, Buffett summarized his stock-picking secret into the moat theory. He believes that finding companies with moats, buying their stocks, and holding them long-term will yield superior returns. Companies like Coca-Cola and American Express are examples of companies with moats. However, Buffett has never systematically explained what exactly constitutes a moat. Many people have analyzed this theory from the perspectives, but today's book, The Little Book That Builds Wealth, is considered one of the most systematic and clear explanations. The author of the book, Pat Dorsey, is the director of equity research at Morningstar, a top-tier investment research and rating firm. His views are frequently cited by well-known media such as USA Today and CNN. Morningstar conducts extensive research on the moat theory and uses it to guide its business. Every analyst at Morningstar builds analysis models based on this theory, regularly discussing and reporting on moat evaluations. The moat theory has become the most widespread and fundamental rule in the company's culture and a primary theme in their market analysis reports. As a Morningstar representative, Pat Dorsey introduces their research results on the moat theory in this book. This audio review will cover the book's main content in 3 parts. First, why are companies with moats more valuable investments? Second, how do you identify a moat? Third, how do you judge if a company's moat is being eroded? First, let's address why companies with moats are more valuable investments. To begin with, what is a moat? Simply put, a moat is a company's competitive advantage. We can understand this from 2 aspects. First, this advantage is long-term, enabling the company to continuously create value, making it difficult for competitors to imitate or surpass. Second, this advantage can originate from multiple sources. It can be inherent, such as advantages formed by geographic location, natural resources, or being in a sunrise industry. It can also be accumulated over time, such as an extensive operational network, or granted by law, such as patents or specific exclusive operating licenses. The role of a moat is substantial. When we talk about moats, we often use this theory to measure a company's value, but fundamentally, the moat's role is to protect a company's safety. Companies with moats find it easier to overcome difficulties. For example, Coca-Cola's strong brand and distribution channels are its moat. In the early 21st century, Coca-Cola introduced a new drink called C2, the predecessor of Coke Zero. C2 tasted similar to regular Coke but had half the calories. However, the market needed to be more receptive because consumer preferences had shifted to non-carbonated drinks like water and juice. Coca-Cola was significantly impacted but quickly launched bottled nutrient water, leveraging its brand and channels to overcome the crisis. The moat protected the company and, in turn, the investors. Some companies experience rapid growth early but fall from grace overnight. Investors who are unthinkingly impulsive and attracted by these companies' fast growth might suffer significant losses when the company declines. However, companies with moats can maintain a relatively high return on investment over the long term, even with stock price fluctuations. In the long run, investors can still achieve good returns while reducing the risk of total loss. Understanding the concept and role of a moat, what kind of competitive advantage qualifies as a moat? Before answering this question, consider what doesn't qualify as a moat. In real life, we often have some misconceptions, mistaking good products, high market share, good execution, and a good CEO for a company's moat, but they aren't. Let's analyze this one by one. First, let's look at good products. Usually, a company with only a good product as its competitive advantage will easily attract competitors. Even if it initially yields high returns, they will diminish over time. Ultimately, the company can only enjoy short-term excess profits, making it difficult to form a moat. For example, in the 1980s, Chrysler introduced a minivan that generated excess earnings in the first few years but soon attracted many competitors with equally good products, leading to a decline in overall industry profits. Chrysler had to abandon the minivan market and related parts business without other competitive advantages. So, why isn't high market share a moat? A high market share indicates profitability, inevitably attracting competitors. If a company only has this advantage, it will easily be squeezed by competitors and unable to maintain long-term excess profits. For example, Kodak once held 2/3 of the global photography market share but lost its position because it needed to establish or strengthen its moat. Additionally, some companies have strong execution skills and are adept at managing and solving problems, allowing them to achieve operational goals more efficiently and steadily than competitors. It may be an advantage in efficiency-based industries like piecework. Still, for most other sectors, if proprietary processes do not support high efficiency, competitors can easily imitate or surpass them, preventing them from becoming a sustainable competitive advantage. A brilliant CEO or management team can make a company run more smoothly and effectively, especially superstar managers who can significantly increase a company's value. However, the author argues that, in most cases, the actual impact of individuals on large organizations is limited. The influence of managers on corporate performance is less significant than we imagine, and individual managers are prone to uncertainty and mobility. At the same time, a company's moat needs to be maintained for a long time. Now we know that good product quality, high market share, strong execution, or an excellent management team are not moats. The true moats discussed in this book are only structural competitive advantages that allow a company to maintain a high return on capital over the long term. Next, let's introduce the second part, identifying an actual moat. The book primarily describes 4 types of moats: intangible assets, switching costs, network effects, and cost advantages. Let's take a closer look at each. First, let's discuss intangible assets. These do not have a physical form and manifest as certain technologies or legal rights. The main intangible assets are brands, patents, and legal licenses, which can be a company's most valuable competitive advantage. Let me explain these factors in detail. Typically, a good brand can grant a company pricing power, allowing it to sell products at higher prices because users are willing to pay more for the brand. Alternatively, it can reduce customers' search costs even if the brand does not confer pricing power. When users think of the brand, they immediately know the quality and features of the product and are thus willing to pay for it. In this case, the brand is the company's broad and robust moat. For example, diamonds with the same basic metrics, such as grade, clarity, and carat weight, can be nearly 50% more expensive when branded by Tiffany. It is the power of a brand. Of course, Tiffany's diamonds are a luxury product. A well-known example from the pharmaceutical industry is Bayer's aspirin. Chemically identical to other brands' aspirin, Bayer's product sells for twice the price. This pricing power is the strength of the brand. Now, let's look at patents. We know patents are legally protected rights prohibiting competitors from producing and selling your product for a certain period, creating a temporary competitive advantage. If a company can continuously innovate and obtain patents regularly, it can form a sustainable competitive advantage. For instance, 3M, a renowned multinational conglomerate, produces various products, including sandpaper, tape, mobile phones, laptops, and cars. With numerous new patented products, 3M holds thousands of patents across hundreds of product categories. These patents constitute 3M's moat. Next, we have legal licenses. Obtaining a legal license requires specific qualifications and approval from regulatory authorities, which is cumbersome. Once approved, the company gains a monopoly advantage in a particular business, forming a broad moat. Take credit rating agencies in the U.S., for example. To qualify for rating bonds, an agency must be certified as a nationally recognized statistical rating organization. The approval process is lengthy, but the profits can be substantial once approved. For example, once it obtained this qualification, Moody's Investors Service achieved a profit margin of over 50% and a return on capital of 150%. So far, we've discussed moats formed by intangible assets, covering brands, patents, and legal licenses. Let's look at the second advantage that can create a moat: switching costs. Switching costs are the costs that users incur when changing from one product to another. The higher the switching costs for users, the broader the company's moat. If someone has always used an iPhone and switched to a Google Pixel phone, it may save money, but it could result in many inconveniences. For instance, transferring contacts between the two phones can be a hassle. Some apps available on iOS might not be available on Pixel's Android system. These inconveniences represent switching costs. Switching costs include economic costs, time, convenience, and other factors. High switching costs mean that a company has a moat. Switching costs vary across industries. Switching costs are low for daily consumer goods like toothpaste and clothing. It's easy to switch from Colgate to Crest with almost no cost, making it hard to form a competitive advantage. However, switching costs are much higher in the banking and software industries, allowing for broad moats. Take bank accounts, for example. If you've ever had an account at a bank used for payroll, bill payments, etc., you've likely developed a habit and reliance on that account. You would only switch to another bank if it lowered its account opening fee or offered some small incentives, as switching costs are too high. First, switching accounts takes time. You need to close the old account and open a new one, which involves filling out numerous forms. Second, there's the risk of something going wrong in the transition, potentially affecting your payroll. Therefore, most people only open accounts at one bank or frequently switch between them. This high switching cost keeps the banking industry's profit margins stable. In the U.S., the average return on capital for banks is 15%, which is relatively high. Thus, high switching costs create a moat for the banking industry. Next, let's discuss the third competitive advantage: network effects. For individuals, the more people you know, the more extensive your network of reciprocal relationships, increasing your social value. The same applies to businesses. If the value of a product or service increases as more people use it, the company can benefit from network effects. Examples include the internet, credit cards, and some financial product exchanges. The author believes that companies built on network foundations are likelier to form monopolies, so that network effects can provide substantial competitive advantages. Moreover, significant network effects usually take years to establish. Once a company forms network effects, competitors often find it hard to surpass it. Take Microsoft, for example. Most organizations and individuals use Microsoft Office and Windows systems. Word and Excel have become universal tools because everyone uses them. In this scenario, even if a competitor launches a word processing or spreadsheet software that is half the price and 5 times more convenient, it would still struggle to gain market share. After all, you want the Word document you send to others to open smoothly on their computers without causing communication issues. Thus, network effects are more common in businesses based on information sharing or user connections. In these businesses, one person using the product does not affect others' use. Everyone can use the same product simultaneously. For example, I can't drive the car you're driving today, but my use of Facebook doesn't prevent you from using it. Facebook now has 1 billion users, with hundreds of millions logged in simultaneously without affecting each other. The significance of network effects lies in the fact that the more people use these networks, the more valuable they become. Finally, let's discuss the last advantage: cost advantage. It is easy to understand that lower costs than competitors provide a company with a moat. Customers usually buy from whoever offers the lowest price in specific industries, making cost advantages particularly prominent. So, how can we identify industries with cost advantages? The author provides a simple and effective method: determine whether the product can be substituted. For instance, the Boeing 737 and Airbus A320 are complex aircraft products, but to most customers, they are almost indistinguishable, with the same functions, structures, flight distances, and passenger capacities. Therefore, price becomes the only advantage, and whoever offers the best discount wins. For companies, cost advantages can come from various factors, such as geographical and resource advantages. However, the critical factor discussed here is the cost advantage created by scale. The author believes that scale advantages create the most enduring moats. The larger the scale, the greater the competitive advantage. However, the crucial point is not the absolute scale of the company, but its relative scale compared to competitors. A small company can have a solid moat if its relative scale is more significant, such as having a more extensive operational network or outperforming competitors in a specific market area. For example, Darden Restaurants in the U.S. operates several seafood restaurant chains. Although Darden is not the largest in the industry, it has an advantage over its competitors, an extensive distribution network that supplies fresh seafood to 650 restaurants across North America with higher efficiency and lower costs. It creates a moat that competitors cannot cross. Another example is Graco Incorporated, a small and relatively unknown company that produces high-end industrial pumps. Despite its small size, Graco has a return on capital of 40%. There are many pump manufacturers, but the high-end industrial pump market is small, making it unattractive to large companies. Even if competitors enter, the market share must be more significant to divide. Therefore, Graco has almost a micro-monopoly in this field, creating a competitive advantage that forms its moat. This concludes the second part, which explains how to identify moats. Intangible assets, switching costs, network effects, and cost advantages can all form a company's moat. If a company has one of these advantages and is sustainable, it has a moat, a broad and solid moat. Of course, having a moat doesn't mean it's invincible, it can still be eroded. The core content we'll introduce is judging if a company's moat is being eroded. But if you notice a company that used to raise prices regularly starting to show weakness in front of customers, meaning customers are no longer buying, that sends a strong signal, its competitive advantage may weaken, and its moat is likely eroded. For example, at the end of 2006, Morningstar analysts found that Oracle, a company selling database software, had stopped its usual practice of raising software maintenance contract fees. Typically, software companies provide large enterprises with complex software and can charge high maintenance fees with annual price increases. These enterprises usually prefer the original software provider for maintenance since they are most familiar with the software code and the latest versions. Despite grumbling about the price hikes, they still pay up. However, third-party companies started offering specialized software maintenance services at lower costs, and customers no longer needed to upgrade their software versions. It affected Oracle's profitability, indicating that its moat was being eroded. So, what factors can erode moats? The book lists 3 main reasons. The first factor is technological change. In an industry, if another company launches a new product through technological innovation that is both high quality and affordable, it could mean your moat is being eroded. The U.S. media industry serves as an example. Before the internet, traditional media outlets like Time, Newsweek, and others had broad moats and dominated the industry. They were very profitable and raised prices each year. But with the rise of the internet, people started getting news online for free, severely impacting the print media industry. The profit margins of these once formidable media outlets began to shrink. The second factor is industry changes. Industries have life cycles, and the competitive dynamics within an industry can change over time. As the market evolves, the competitive landscape may shift, altering the balance of power among companies. For example, the retail industry has undergone significant changes with the rise of e-commerce. Traditional brick-and-mortar retailers have had to adapt to the new online shopping environment or risk losing their market share. The third factor is management decisions. Poor management decisions, such as failing to adapt to market changes, investing in unprofitable ventures, or misallocating resources, can weaken a company's competitive advantage. Effective management is crucial for maintaining and enhancing a company's moat.